Hello and welcome. When you start building an investment portfolio, you'll quickly encounter two fundamental building blocks: stocks and bonds. You've probably heard these terms, but what do they actually represent? And more importantly, how should you think about them when it comes to your own money? It's easy to get intimidated, but understanding the relationship between stocks and bonds is one of the most important steps you can take as an investor. It's the core of a concept called asset allocation, which is just a fancy way of saying how you divide up your money. Getting this right is crucial for managing risk and working towards your financial goals. In this video, we're going to demystify these two pillars of investing. We'll clearly define what stocks and bonds are, explore their different roles in your portfolio, and provide a simple framework for how you can start using both. Let's begin. Part 1. What are stocks and bonds? The ownership versus loan analogy. Let's start with the most basic distinction. When you buy a stock, you are buying a small piece of ownership in a company. When you buy a bond, you are providing a loan to a company or government. Let's make this practical. Imagine a local pizza restaurant wants to expand. The stock route: the restaurant could decide to go public and sell shares of its company. If you buy one share, you are now a part owner of that pizza joint. You have a claim on a tiny fraction of its future profits and assets. If the restaurant becomes the next Domino's, the value of your share could skyrocket. But if it struggles and goes out of business, your share could become worthless. As an owner, you are last in line to get paid if things go wrong. Buying a stock is a vote of confidence in a company's long-term growth potential. The bond route: instead of selling ownership, the restaurant could borrow money by issuing a bond. They might say, "Lend us $1,000 for 10 years, and we will pay you 5% interest each year." You lend them the money, and in return, you get an IOU. That's the bond. The restaurant is now legally obligated to make those regular interest payments, called coupon payments, and to pay you back the full $1,000 at the end of the 10-year term, known as the maturity date. Your return is fixed and known in advance: the steady interest payments. Your main risk is that the restaurant might default on its loan and stop paying you back. So, to summarize, stock equals ownership. You're an owner, hoping the company grows. Higher potential reward, higher risk. Bond equals loan. You're a lender, expecting to be paid back with interest. Lower potential reward, lower risk. Part 2. Why this distinction matters: risk and return. Now that we know what they are, let's talk about why they behave so differently in your portfolio. It all comes down to the trade-off between risk and return. Stocks, equities, the growth engine. Because you are an owner, your success is directly tied to the company's success. If the company grows its profits, the value of your piece of the pie can grow dramatically over time. This is why stocks have historically provided the highest average returns of any major asset class, around 10% annually for the S&P 500 over the long run. But this potential for high return comes with high volatility. Volatility is just a fancy word for price swings. The stock market doesn't go up in a straight line. It has sharp downturns, corrections, and bear markets. If you need to sell your stocks during one of these downturns, you could lock in a significant loss. Stocks are for growth, but they require a strong stomach and a long-time horizon. Bonds: fixed income, the stabilizing anchor. As a lender, your return is contractually limited to the interest rate. You won't get explosive growth, but you also don't have the same wild price swings. The primary value of bonds in a portfolio is stability and income. They provide steady, predictable cash flow from their interest payments. And when stock markets are crashing, investors often flee to safety, which means they sell risky stocks and buy safer government bonds. This often causes bond prices to go up when stock prices are going down. This negative correlation is like magic for your portfolio. It acts as a shock absorber, smoothing out the ride and preventing you from panicking and selling all your stocks at the worst possible time. However, bonds are not without risk. The main risks are interest rate risk. When interest rates go up, existing bonds with lower rates become less valuable, so their price falls. Inflation risk. If your bond is paying 3% interest, but inflation is 5%, you are effectively losing purchasing power. Default risk. The small chance the issuer, like a company, can't pay you back. Part 3. How to use stocks and bonds in your portfolio. So, How do you bring these two pieces together? It's not about choosing one over the other. It's about blending them in the right proportion for you. This is your personal asset allocation. Your ideal mix depends almost entirely on two things: your time horizon and your risk tolerance. Time horizon. This is the number of years until you need to spend the money. Long-term goals, 10+ years. Like retirement for a young person, you have time to ride out the volatility of the stock market. Your portfolio should be heavily weighted towards stocks for growth. A common rule of thumb is 110. Your age should be the percentage in stocks. So, a 30-year-old might have 80% in stocks and 20% in bonds. Short-term goals, less than 5 years, like a down payment for a house. You can't afford a market crash. Your money should be in safer assets, predominantly bonds and cash equivalents, like a high-yield savings account. Risk tolerance. This is your personal ability to sleep well at night when your portfolio value is jumping around. If you check your portfolio every day and feel sick during a 10% drop, you have a lower risk tolerance and should have a higher allocation to bonds, even for long-term goals. If you can see a 20% drop on your statement and not feel the urge to sell, you have a higher risk tolerance and can stomach a portfolio with more stocks. How to actually invest in them? The easiest way for a beginner to invest in both stocks and bonds is, once again, through ETFs. For US stocks, you can buy a fund like VTI Vanguard Total Stock Market ETF or IVV iShares S&P 500 ETF. For US bonds, you can buy a fund like BND Vanguard Total Bond Market ETF or AGG iShares Core US Aggregate Bond ETF. You can build a simple, diversified, and powerful portfolio with just these two funds. You then adjust the ratio between them based on your time horizon and risk tolerance. A final word of wisdom to quickly recap. What are they? Stocks represent ownership in a company, while bonds represent a loan you make to a company or government. Why do they matter? Stocks are your portfolio's growth engine, offering high returns with high volatility. Bonds are your stabilizer, providing income and safety, especially when stocks fall. How do you use them? Blend them based on your personal time horizon and risk tolerance. A long-term, aggressive investor might be 90% stocks, 10% bonds, while someone nearing retirement might be 50/50ths or 60/40ths. Think of your portfolio as a ship on a long voyage. Stocks are the sails, catching the wind to propel you forward quickly. Bonds are the keel, hidden beneath the water, keeping the ship stable and upright during storms. You need both to reach your destination safely. Understanding this fundamental balance is what separates a nervous saver from a confident, long-term investor. Thank you for listening.